to let you know the 7 key facts that every property investor absolutely must know regarding these, I'd like to welcome Washington Brown's Director and CEO, Tyron Hyde.
Thank you, Peter. Well said. Look, this is the biggest change. There are massive changes coming ahead. It's gone from the draft bill stage now to the government had an open consultation period, which I was invited to discuss with them, and now the draft legislation has gone to the final legislation that's in Parliament now, waiting to be voted on. I've been a quantity surveyor now for 25 years, and this would be the biggest change I've ever seen. So I'm going to discuss those changes with you tonight, discuss the implications of them, but it really has changed the game for property investors. More importantly, it's changed the investment equation, which I'll show you later. Before I get onto that, we're just going to run a quick poll, aren't we, Peter?
We certainly are. So that should be appearing in front of everyone. Look, this is just so we get to get a bit of a feel for our audience. There's no right or wrong answer here. It's not a test. But if you can take some time to answer that one, it'd be very helpful. Just as I said, lets us know a bit more about our audience and who we're talking to. So I'll leave that up for another second or so.
It's not a postal survey, though.
No, definitely not. All right, thanks very much for that, guys. I'll pop that one away.
Great. So before I get on with this talk tonight, I just want to tell you I'm Tyron Hyde. I'm the CEO of Washington Brown. I'm a quantity surveyor. And what quantity surveyors do is we work out what things cost to build. A major part of our business is in the production of depreciation schedules, and I know a lot of you out there are actually Washington Brown clients, so you probably have one of our reports. The reason that I'm sitting here tonight was that in 1997, the tax office put out a ruling, which was TR 9725, which identified quantity surveyors as being the appropriate body or appropriate industry to estimate costs where the costs are unknown, construction costs, that is. It was a good ruling for Washington Brown and other quantity surveyors, because if you don't know the construction costs of a property, you have to get someone like us to estimate those costs. And the ATO accepts our estimate. So that's why I'm sitting here tonight. So what's changed? Well, lots has changed, or lots is about to change. In the good old days, I'm talking all of 4 months ago, before the 9th of May when the budget came out at 7:30, as quantity surveyors, we would go out to buildings and we would break the property into 2 components. When you receive a depreciation schedule, there's 2 components of that. There's the plant and equipment in the property, which is your ovens and dishwashers, etc., and there's the construction, the building allowance, which is the structure of the building. So the plant equipment, as I just said, that's the Division 40. That's your ovens, carpet, light fittings, dishwashers, etc. Now this stuff depreciates quicker than the other part of a depreciation schedule, which is the Division 43 allowance. That's the structure of the building. Now, in order for you to claim the depreciation of a building, the property has to be built after 1987. Okay. But to put that in perspective, those costs represent about 85% of the overall construction costs. And as I said, that's the structure, the brickwork, the windows, the tiling, etc. And how that works is an investor gets to claim that, but based upon its original construction costs at 2.5%. So if a property today was built for $200,000, you'll be able to claim the structure of the building at 2.5% for the next 40 years. If the property is 10 years old, we work out what it cost to build 10 years ago, and you then would have, if you bought it today, you'd have 30 years left. But you'd still be claiming 2.5% of the original construction cost. So, what has the government done? This is straight from the budget statement. They are going to deny income tax deductions for the decline in value of previously used depreciating assets. It's got nothing to do with the brickwork and concrete. This is purely in relation to the plant equipment in the building, the ovens, the dishwashers, etc. Why are they doing this? Well, this is again from the budget statement. This is an integrity measure to address concerns that some plant and equipment items are being depreciated by successive investors in excess of their actual value. And I agree with them. There was a problem in the way that property investors were claiming, repeatedly claiming old plant equipment items. We would go out to properties and we would say, well, you know, as part of your purchase price, even though the property might be 20 years old, we would say, well, as part of your purchase price, there was an oven there that you paid for that might be worth $500. Even though the previous owner had written that oven all the way to 0. And that's what they wanted to stop, and it's fair enough. I think they've gone too far in the way they're doing it, but there was an issue. And the issue is not because quantity surveyors were doing this. The issue is that there was no clear legislation on how to value second-hand plant and equipment items in second-hand properties. And I'll give you an example. Okay, and this is a real example. This happened in our building last week. Someone bought a commercial suite. I'm sitting here in 321 Pitt Street. Someone bought a commercial office in our building for $600,000. Now our building's about 50 years old. If we were to go and do a depreciation schedule on that property, we'd say, well, someone just paid $600,000 for it. Well, there must be $2.5 grand worth of carpet in there, right? The next day, someone came along and offered that same owner $800,000 for the exact same suite. He took it, smart man. But how do we value the plant and equipment that's one day older? It's 1 day older, but the property price has gone up $200,000. Didn't that new purchaser just pay more for the carpet? That would make logical sense. However, it would also be logical that it's 1 day older and the carpet has just depreciated. And therein lies the problem of what they're trying to stop. So possibly another way of looking at how they're going to stop it was actually legislate the valuation methodology, not just have a cold hammer, sledgehammer, and stop it altogether. But I'll go into that later. So the bad news, boo. So this is what's going to happen. When you buy a second-hand property, if you buy a second-hand property after the budget, 9th of May, you'll no longer be able to claim depreciation on ovens, dishwashers, lights, aircon, television sets, carpets, lounge suites, everything. All that loose stuff you can't claim depreciation on anymore. And it's not just the internal items. It's also the common property items. So when you buy an apartment in a high-rise, for instance, you get to claim a portion of the lifts. That's considered plant equipment. If it's second-hand, it's now considered previously used. You can't claim your portion of the lift. You can't claim your portion of the smoke detectors. You can't claim the common carpet, garage motors, doors. Oops. And leaving that bad thought, we're going to run another poll now, aren't we, Peter?
We are indeed. So now that you all know a bit about the changes, very interested to see whether you knew about these changes, that the government had made these changes to depreciation legislation prior to the promotion of today's event. Once again, there's no fail. You're not going to have to repeat the class. It's just for our curiosity, and once again to get to know the audience a bit better. Appreciate your participation. I'll let that go for another few seconds. All right, thank you very much, everyone.
Great. So now I've told you the bad news. Let's get some good news. Who wants some good news? Put your hands in the air. Me. So the good news is, well, for starters, new property is not affected at all. So if you buy a brand new property, you can still claim the depreciation on the plant equipment and on the building allowance as well. The government obviously didn't want to halt construction because when a lot of developers rely on the fact that when they market properties, they are going to say, well, we've got a lot more depreciation compared to a second-hand property, and therefore be able to sell those properties off the plan. And obviously, when you're building and developing stock, there's a lot of knock-on effect by that. There's a lot of trades being paid, a lot of tax being paid, etc. So they don't want to stop construction. So new property is still okay. The great news is it's grandfathered. So all you out there that have a existing depreciation schedule, you continue to claim exactly what you're doing. So if you bought a property prior to the budget, nothing's changed. And if you have and you haven't got a depreciation schedule, now would be never be a better time to get one because you might not get these allowances again. So it's vital there. But I just reiterate, because whenever we do this, these webinars, someone says, oh, but I bought before, what happens? Well, it does not change. If you bought before the budget on May 9, nothing has changed. There's no change to the Division 43 deductions, the structure of the building. And as I said before, this represents 85% of the overall construction cost. So we're really only talking about 15% of the construction cost that's been affected here. So all the structure, the brickwork, concrete, there's absolutely no change to that at all. Offices, industrial, hasn't changed at all. If you were to buy a retail shop or a small office suite, it's exactly the same way you can claim the depreciation on a second-hand carpet in an office, but not in residential. I think that's a bit silly. I don't see why the government's suggesting that the system is broken in residential, but continues to allow a broken system occurring in non-residential moving forward. I would have thought that if it's broken, but they obviously didn't. I suspect it's possibly got to do with some lobby groups, but that's just me. But yeah, so you can still buy a second-hand office, industrial building, and continue to claim second-hand carpet exactly as you can now, but not residential. The entity. So there's certain entities that they've exempted, right? So you can buy a property in a company name, and you can still claim the depreciation on a second-hand property. You can still buy a property in a super fund. It's not a self-managed super fund. It has to be a large super fund like a uni super, but they've clearly said self-managed super funds are not exempt from this budget change. You can buy a property in a large trust, or a large trust can buy a property as long as it's got 300 members or more, and it can still claim the depreciation on a residential second-hand property. Don't ask me why, but that's what they've said. Now, renovations. Everyone asks a lot of questions about this. So if you are to renovate a property and you actually carry out the work yourself, or you engage a builder to carry out that work, the costs are known, it's brand new, so therefore you can still claim the renovation of the structure as well as the plant equipment, because you've got an invoice for it. It's brand new when you put in that new oven. So therefore you can still claim it because the costs are known and also it's brand new. However, if I was to buy a renovated property, right, someone else did the renovation, I can't claim, and they lived in it for 6 months or a year, I can't claim the oven and the dishwasher moving forward. It's now previously used. I will be able to claim the depreciation on the structure of the renovation, the new kitchen cupboards or the new brickwork, but I can't claim the one-year-old oven on that renovation. So one would ask, what's going to happen? What is the tax effect of that previously used property, of that previously used plant and equipment moving forward when I sell the property? That'd be a very good question. And this is from the budget statement. Acquisitions of existing plant and equipment items will be reflected in the cost base for capital gains tax purposes for subsequent investors. Does that make sense? I tried to put a little scenario here for you to make sense of that. So what they're saying now is this is a CGT equation, right? So Peter, that's not you, Peter, that's a generic Peter, but Peter buys a property for $600,000 in 2017, and this is a second-hand property. And within that property, there was $30,000 worth of plant equipment. Peter then sells the property for $800,000 in 2020. And that $30,000 original plant equipment would have been written down to $10,000 if normal depreciation applied. Right? So the undeducted depreciation of the plant equipment is $20,000. That's a 30 minus a 10. Right? Normally, Peter's CGT equation, or capital gains tax, he would have to pay $800,000 minus the 600, i.e. the new sale price less the original. Would be he's made a $200,000 profit. But because Peter couldn't claim the depreciation on that second-hand property, and that plant equipment, the undeducted plant equipment depreciation was 20 grand, Peter can take $20,000 off his capital gains tax liability. So Peter only now pays capital gains tax based on the 180K. So what the government is doing is in effect saying you can't claim the depreciation on the way through, but when you sell the property, you can claim a capital loss for what you didn't claim. They've just moved it from one line of the budget to another. Seems like a lot of work for me, just to get the same result. Anyway, show me the numbers. So what does this all mean? Well, okay, I'm going to give you three examples now, based upon a brand new property, a property that's 10 to 20 years old, and something that's really old. Okay, so if you would buy a brand new property today for $850,000, the year one depreciation might be 20 grand, year two 17 grand, first 10 years will be $135,000 in depreciation. After the budget, it's exactly the same. Because it's brand new, there's no change. Makes sense? If you were to buy a property that was built in the year 2000 for $850,000, same purchase price, but it was built in the year 2000. There's a big difference. The first year prior to the budget was about $15,000. After the budget, you're going to get about $6,000. Second year, 13 prior to the budget. Second year, after the budget, 6. Now, as you can see, years 1 to 10 on the post-budget, it's all the same, and that's because all you're claiming is the structure of the building. In the column here on the left, the pre-budget depreciation, it's 15, 13. The reason they're higher is that's what the plant equipment is. As you get towards year 10, it's pretty much the same because the plant equipment's written down, and all you're left claiming after year 10 is pretty much the building allowance anyway. So that's why it's very similar. The problem is that property investors generally need a lot of higher deductions at the beginning because that's when that's when you need more deductions to afford that property. After 10 years, you would hope the rent has gone up significantly. It's more, and it becomes more affordable. But you can see that there is a significant drop in the first 5 years and so. Final example: if you were to buy a property that was built in the year 1986, and I say 1986 because in order for you to claim the structure of the building, the property has to be built after 1987. So if you were to buy a property that was built in 1986 for $850,000, after the budget, you're going to get $0 depreciation because you can't claim the structure of the building. Prior to the budget, on the left-hand side, you would get $6,000, $3,000, $2,000, and that's in essence we're saying that there's about $17,000 worth of plant equipment items in there that are second-hand: the carpet, the ovens, the dishwashers. So you can see the big difference there from $6,000 in the first year pre-budget to $0 now. But I've got to be honest with you, this is a pretty rare scenario because it's not often you would buy a property that's 30 years old that hasn't had a renovation. Right? If you want to buy a property that's 30 years old and rent it out and make it tenantable, invariably it's either been renovated 10 years ago or you're about to renovate it. It's not that often that we see properties that are built pre-1987 that have had no renovation. So invariably a depreciation schedule will still be worthwhile. But let's look at this in the actual finite details. What I want to show you here is the net effect of the cost of owning a property. And I've broken this down into 3 examples. I said, okay, for the first property, I said that let's look at if you were to buy a property for $750,000, I'm going to compare a brand new property versus a property that's built between 1987 and 2016 and a property that was built before 1987. And show you what the net effect of cost of ownership per week is. So I've assumed for the first, the rent will be the same for every property. So for each property will get $700 a week rent over a 52-week period, which is $36,000 for each property. I've said for each property you're going to borrow 80% of the purchase price at 5.5%. That is $33,000 each in interest. So I've made it the same just to show you the net effect of the depreciation. I've said for each property that there's going to be other expenses at 1.5% of the purchase price. So that's $11,250 for each property. It could be argued that a property that was built before 1987 could have a higher expense rate there because it might be due a special levy because it's an older property. So in exact same scenario for each property, the net outlay before depreciation is $7,850. That is, I've received rent of $36,000, I've had to pay borrowing costs of $33,000, and I've got my other expenses of $11,250. So it's a negative $7,850. Now let's factor in depreciation, which is a non-cash deduction. That means I didn't have to pay, I didn't have to physically send a check to anyone, except to Washington Brown to get a depreciation schedule. But in the brand new property, the depreciation year 1 is $15,000. For the property aged 87 to 2006, it's $4,000 because all you're claiming there is the structure of the building, and a property built before 87 is $0. So my total tax loss on a brand new property is quite high. It's the physical costs I paid out of $7,850, added together with the 15, makes it, I've got a negative $22,000 loss. Now, taking that example, if I'm on a marginal tax rate of 37.5%, and I've just got a loss of 22, I get a tax check back from the ATO of $8,455. Right? That's cash in the hand, $8,455. However, I've physically paid out $7,850. Right? So it's actually paying me to own $605. I've got a tax check from the ATO of $8,455. I've physically paid out $7,850. It's paying me $605 a year to own that property. $12 a week cash flow positive. Let's look at the one before 87, built before 87, to give you the two extremes. Again, I've physically paid out $7,850. I've got no depreciation. My total tax loss continues to be, or only, not only, but it is minus $7,850. I've got a tax loss there of $7,850. At 37% income tax rate, I've got a tax refund of $2,905. Now, I've paid out $7,850. I've got a tax check of $2,905. So my cost, it's going to cost me, physically, it's going to cost me roughly $5,000 per annum to own. So it's going to cost me roughly $100 a week to own that property built before 87, as opposed to getting paid to own that property because I've got that big depreciation number. Interesting. Who wants some great news? The great news is I've still got a job. You're still going to need a quantity survey to work out what the cost of construction is. In actual fact, nothing's really changed. That was the only ruling in TR 9725. Quantity surveys were identified to work out the construction costs, and you'll still need that. You'll still need us to work that out. You'll still need, in my opinion, someone to work out or to value those plant and equipment items in order for you to claim the loss when you sell the property, or replace those plant and equipment items along the way. But I'll get into that in a little bit later. Now, why are they doing this? I said before that it was an integrity measure, but another factor was housing affordability. This is all under the housing affordability bill that the government has said. I think this could go two ways. Initially, I thought, well, everyone's just going to hold on to their property. It's going to reduce supply. And that could quite possibly happen. Now, I'm not the greatest Rhodes Scholar economist, but I do remember from economics in high school that if you reduce supply, so price is a factor of supply and demand, and if you reduce supply, well then in theory price could go up. The other side of the equation is that having less depreciation deductions, there'll be less investors out there looking, and less investors will then, there'll be less demand. That could reduce pricing. I think these things really are minor. There's bigger things at play. Rather, like, is the actual market peaked? will have a greater impact. I don't think the Perth market's gone backwards so far because of the huge depreciation deductions that people have been claiming, or what have you. Or places like Moranbah. We do reports up in a place called Moranbah in Queensland, and we look at these purchase prices. During the mining boom, people were paying $800,000 for a house. We're doing depreciation schedules for that same house, or similar type of house now, where people are paying $100K. Depreciation wasn't a factor. Negative gearing wasn't a factor. Many other issues at play. So that's workable. I just went through that. Jury's out. So, looking into my crystal ball, I've said to myself, what are going to be some of the impacts of these changes? What do I foresee? Well, the first thing.
For the record, that is a stock picture. That is not a picture of Tyron consulting his crystal ball in the office.
No, but it's a good picture. I've got some good pictures here, I reckon. Anyway, this is one of my favourite pictures. But anyway, back to, so looking into my crystal ball, what do I see moving forward in relation to these changes? The first thing I reckon is going to be guaranteed. A lot of project marketers and developers are going to change their advertising strategy, and you're going to see some ads on the Saturday paper or online saying, buy brand new, we've got the depreciation allowances. That's going to occur. I don't know if that's a good thing. I think possibly some people might be buying new property. There's a bit more unscrupulous people sometimes selling new property than there are selling a second-hand property. So I don't know if that's a great thing, but I guarantee you there's going to be some change in advertising based around these changes. Mark my word. I think the other thing, you're going to find that some people might start buying properties in company name. And I did. I just bought a property in the UK. I know all your accounts out there are saying, no, don't do that because you won't get the CGT discount. And I know that. but I just bought, hear me out, I just bought a property in a company name in the UK. I paid £40,000 for it, and I get £400 a month rent. £40,000. Can you believe it? It's a 2-story renovated townhouse in a place called Durham. And, that's the price of stamp duty, isn't it, in Sydney? Anyway, I know I won't get the CGT discount if I sell the property, but guess what? I don't have any intention of selling the property. And at the end of the day, even if I did sell it, the way that company tax rates are going, they're getting lower and lower. And for example, let's say I sold a property today for $100,000 profit, right? That's going to be added to my personal income tax of my personal salary. And I'm already on the highest marginal tax rate, so if I hold it for more than a year, my CGT implication is 50 grand. Now, the highest marginal tax rate, that's about $25,000 capital gains tax I've got to pay. Well, the company tax rate is a maximum of 30% and going lower worldwide. Trump wants to take it down to 15%, and let's face it, we're going to have to kind of compete with that. So who knows? 20 years time, the company tax rate here might be a lot lower. But as I said, it doesn't matter because I have no intention of selling it. Because it's in a company name, I can claim depreciation on it. That wasn't a huge issue, but I can. And another interesting thing was, you've probably heard that the fact that the government is also going to limit travel expenses, right? So if you want to fly the Gold Coast and inspect your property, you won't be able to claim that once a year travel expense. But guess what? They also said that if you buy the property in a company name, you can still claim the travel expense. So I can go to the UK once a year on this $40,000 property and it's tax deductible. That's not my intention, but it's there. The final thing was, and again, it doesn't apply to me, so these are some of the factors that you might want to consider. But the other thing is, if I was to buy that, because this property is cash flow positive, I'm not borrowing, because you won't be able to borrow a property of £40,000 in the UK. But because it's all cash flow positive, if my wife wasn't working and she was doing my books, I could possibly divert some of that income to her. It doesn't apply to me because my wife works, etc., etc. But this is what you did. And I was giving a seminar recently. You were there, Peter, and the accountant before me got up and talked about so many different options of buying property, and don't just always have the same mold. Every property is different in your needs. I own properties in my super fund. I own properties in trust funds. I own properties in personal name, and now I own property in company name. So I guess what I'm saying is, firstly, before you buy any property, discuss it with your financial advisor, because once you set up that structure, it's very hard to change thereafter. So not every property fits every mold.
And very expensive to change after too. I guess that accountant that was at that seminar you're referring to, Ty, I think his point was just to consider the options before making that purchase, because there are options. Yeah,
that's right. So back onto my crystal ball. I think what you'll find is, moving forward, that quantity surveyors will be changing the way that they produce reports. There might be an option for you to get just the capital allowance report and possibly a report that identifies plant equipment, and a combination of both. I know some people are already doing that, so I think that will certainly be a change moving forward. I think there's going to be confusion. I think this guy's confused, and I think, since this has occurred, we're constantly getting asked questions. I constantly have to go to this legislation and say, well, what about that? What about this? And I'll give an example. Okay, so as I said, residential property can't claim second-hand plant equipment. However, you buy a commercial property, you can. Now, there's a lot of properties out there where you might have a retail shop on the ground floor, and you might have a residential property above it. Which is one lot. It's not been stratified, and you buy the combination of the both. Now, so what this new law says, you can claim the carpet in the retail strip, but you can't claim the carpet above. And let's consider it as an example where you've got common air conditioning going through both systems. Half of it you can claim, and half of it you can't. Now, if you replace one of those items that you have been claiming, and the other one you haven't, when you replace that bit, you've got to start the depreciation again. Now, let's say in 5 years' time you sell that property where half of it you've claimed, half of you claim the condition, half you haven't. Some of it comes off your cost base, and then you buy another bit of plant equipment, that then depreciates again. it's going to be very, very confusing to work out what the capital gains tax liability is, in my view. Good luck with that. Sadly, I think there's going to be a bit of hurt in the market for people that have bought brand new, say last year, 2 years ago, and maybe in their super fund and they want to access cash and they're trying to sell a second-hand property that might be like 2 or 3 years old, and you know, there's not going to, and they might be trying to sell it in a market where next door the new block has $20,000 in depreciation deductions, and yours suddenly, even though it's 1 year old, has only $4,000. So trying to sell something near new is going to be a bit more difficult in the future, if you ask me. And hopefully that'll, you know, I know there's been so many people that have, you know, taken their money out of their Telstra super fund or their, you know, reliable super fund and been advised to buy new property, and maybe if they need to actually cash out, sadly it might be a bit hard. There's me. So this is my Super Bowl NFL quarterback moment. So when the draft legislation came out, it went through a consultation period, and the Treasury Office asked me to come in and discuss what I thought of the changes. So there's me with my book and the little badge, and there I am with the flags around me. And so I was pretty proud that they were interested, and I got there, and you know, it's in Pitt Street, Sydney, above Pitt Street Mall. There, the third most expensive strip in the world, and get up there and I think, couldn't this be in Parramatta? An office here. But anyway, once I got over that, they bring me down to this boardroom, and the boardroom was the size of a bus. Seriously, the desk was the size of a bus, and there was 4 operatives down the end of it, and I walked in there and sat down and went through the card ceremony, and I said to me, Tyron, look, would you like us to run through the changes? Have you heard about the changes? Would you like us to run through this legislation with you? I said, heard about it? I know it off by heart. This is my livelihood. And I want to explain to them what they've done. And I did. I told them. And
lost a few nights' sleep in the process too, I might add.
And I wrote, and so anyway, so after that I wrote what I think should occur. I told them what I think some of the issues are that I've just talked to you about. And you know, it was a great meeting. It went for an hour. And at the end of it, I gave them all a copy of my book. So I knew the 4 panel members that were there, and each of them got a signed copy of my book, because I told them what I think they should do, which I'll tell you in a minute what they should do. And each book was signed, Dear XYZ. You know it makes sense. Regards, Tyron. And they laughed. But I did have concerns, and one of the concerns, why I think there hasn't been a lot of thought about what they were doing, comes down to this. You see, and it says there, I've got a little stamp there, so you can't make this shit up. This is straight from the budget, right? And whilst I think this was rushed through, and this exactly explains why it's rushed through, the government, in the budget statements, they're forecasting, because in the same budget statement they had in terms of housing integrity, they discussed 2 things. They were going to disallow the deduction of travel expenses for residential property and limit plant equipment depreciation deduction. Now, the brilliant forecasters have estimated that over the next 3 years, they're going to save $540 million in stopping people flying to their property once off a year over the next 3 years. As opposed
that's a lot of Tiger airfares up to the Gold Coast to visit your property at $49 a trip, isn't it? It's
a massive amount of Tiger Airways flights to the Gold Coast. And they're saying that's double what people are claiming in depreciation deductions over the next 3 years. It's like, really? So that's kind of why I thought, well, I don't think there's been a lot of mathematical forecasting on this. You know, our office alone depreciates property far more than what they're talking about here. So, well, look, maybe they're thinking it's going to be a bonus for them, but I just don't think there's been a lot of thought. And some people that I've spoken to have certainly suggested this was a last-minute thought to quell, you know, to show that they're targeting those greedy negative gearers. But that's just hearsay. So, Tyron, stop whinging about the problem. What's the solution? And this is what I explained to them. I said, instead of just cutting it off cold, creating a problem where you know, second-hand properties might not sell, people might hold on to their property, so you're going to get less capital gains tax revenue. You might get less stamp duty. What you could have done, or should do, is simple. If I buy a brand new property today and the carpet was assessed at $3,000, right, I claim that carpet over, because carpet has a 10-year effective life, I claim it over 10 years at $300 per annum. However, if I sell it to you after 5 years, guess what? I should pass to you a certificate that says, well, I started at $3,000, it's 5 years old, there's $1,500 left. It's logical, it has no relationship to the purchase price of the property. It's purely upon what the original cost of that carpet was. And that's exactly what happens with the brickwork and concrete, the structure of the building. That's actually legislated. You see, when a developer builds a block of units, he has an entitlement or he has an obligation to pass on the construction cost to the first purchaser. And you, as that purchaser, you are supposed to pass it on to subsequent purchasers. Doesn't happen or doesn't often happen, but that's what the law is. So it could be the same. So and that, it could be applied to plant equipment. If the carpet was $3,000 to begin with, and it was sold after 5 years, well, it would just make logical sense that there's half of that value left, wouldn't it? And then, because I said carpet has a 10-year effective life, if I was to buy that unit off you after 12 years, guess what? My claim would be zero, because it's 12 years, the effective life has been used up. Then it wouldn't disrupt the property market.